This space was downloaded via spacesdown.com. Visit to download your spaces today.
Big up the ones and twos. We are back. The Morning Blast is back on X Spaces, Twitter Spaces. It's good to be back. Michael, how are you?
Well, a very good morning to you, Ryan. Good morning, everyone. Can I just say right from the offset, that is possibly the most annoying music I've ever heard in my life.
I can find it more annoying if you want to see. I was thinking maybe we get some Chaz and Dave.
Oh God, that's one that people outside of England won't understand.
Hang on, or Knees Up Mother Brown.
Let's not. In case the Irishman is listening in.
There's a few puns that could be made there. But anyway, moving on swiftly, as quickly as possible. Welcome, everyone. We are back on Spaces. This is the Morning Blast.
Let's be very clear. We never actually went anywhere. We were still doing this podcast.
Oh, yeah.
But,
yeah, we thought because Spaces got a bit troublesome and we thought we'd go on to Podbean. And then Podbean have decided that they are stopping the live streaming service anyway. So we thought, fuck it, we'll come back. It's more stable. But anyway, this is the Morning Blast.
One thing I would say, sorry, on that is...
I'll get the Morning Blast intro out of the way in a minute. You carry on.
Who needs the fucking intro? One thing I would say on that is if there are any technical issues, please do let us know because it all sounds fine to us, but we have absolutely no idea what you're hearing. We could sound utterly appalling. So please do let us know.
But the thing is, let us know. But then what are we going to do? I'll be honest, I struggled inviting you to be a co-host. But look, we'll make up as we go along. Again, I'll get the intro out of the way. This is the Morning Blast. This is your very candid market-related podcast here to put a smile on your face and a bit of value into your day. Nothing we say on podcasts like this are trading or investment advice. If we do have an affiliation with anything, or if we have any open positions, we will make it very, very loud and clear, which apparently is how we're coming across on Spaces due to our dear friend Clive Lambert's telling us in WhatsApp he still refuses to actually tweet or message in the format of where the event is. But, here we are. Dominic, it's great to see Dominic still be the first person to join the live session. He did it on
Podbean. He just wanted to hear the music.
He did. Well, and my dulcet tones. Ooh. But look, let's get cracking. We are killing time because there's not much of a Middle East update to do today. So let's get cracking. S&P pushed higher yesterday. Oh, sorry. This is from our dear friend Clive Lamberts over at Futures Techs. Yeah, I fear change as well, Clive. The S&P pushed higher yesterday, but didn't manage a new high. Overnight, we dipped down to 71.05 and found buyers there. NASDAQ Futures did make another all-time high yesterday, touching the 27,136 level late in the session. Over here in Europe, DAX pulled back to 24 24,014, 24,014 for those wanting normal English overnight, and it's called to gap lower at the open this morning with 24,280 as the gap resistance level to watch. FTSE ran straight into trouble at 10,531 yesterday, which is exactly where the Marabuzu line sat, and it got turned away. Clive does love a Marabuzu line, and it is page 62 in his book. I'm guessing it's 62.
When are we getting royalties for this book? We plug it at least 3 times a week.
To be honest, I'm getting a lot of use out of it. It's keeping the door open. But moving on.
Must be a very light door because the book's quite thin.
No, it's not. It's all right. It's got a bit of weight to it. It's been signed. It says, here's your fucking book. Love, Clive. like quote, that's what it says. Where was I? German bonds. Bund futures have gapped down this morning with 125 spot 48 now acting as gap resistance. Euro dollar, the currency, obviously not the ster, is under pressure again, down to 1 spot 1703 yesterday and touching 1 spot 1692 overnight. If the selling continues, 1 spot 1670 is that's 70 is the next level to keep an eye on. Bitcoin pushed up to 79,500 yesterday. I can see Crypto Cam in the conversations here. So big ups to Crypto Cam. More gains here. From here, hopefully. I'm just happy not to be saying that 74,500 level anymore. Metals broadly saw some overnight weakness, though silver is holding on to support at 75.38 for now. London copper continues to struggle with the Fibonacci resistance at 13,445. In energy space, Brent crude was green yesterday and then spiked further overnight, reaching 106.15. And in European gas markets, TTF, the European benchmark, after Tuesday's bullish engulfing pattern, we got a follow through, with price holding above the Marabuzu spot at 27 and a half, and pushing on from there. As Clive went to print, which was probably about an hour ago, it was up to 45.44. A note of caution on EU carbon markets, that's dropped back through 74 level, which takes some shine off the bullish case that we've been making there recently. So thank you very much, Clive Lambert.
Very good.
Michael, how are you?
I'm not too bad, actually, although I was just reading an article while you were going through that roundup. Apparently, Rachel Reeves has spent £3,000 worth of taxpayers' money on an oil painting depicting.
Have you not seen it?
Her portrait working on her inaugural budget. No, I've only just come across this.
What? You've come across Rachel Reeves' portrait?
That's terrible phrasing.
No, sorry, that I'm just quoting you. Yeah, just making sure that's in the.
Do we have an explicit tag on this?
I'm just hoping that the AI summary picks that up.
No. Move on.
It's thankfully she's only paid that much for it, but I could have done it with some paint by numbers.
Well, it's not obvious that it's her.
Comedy
actually,
penis in the corner.
There we go. Anyway, as you said, we are kind of stalling for time because there's not actually that much to mention this morning. I mean, certainly in the Middle East, Sorry?
I said money's too tight.
Indeed. Yeah, in terms of the Middle East, actually, yesterday was relatively barren in terms of news flow, or at least impactful news flow. There was a little bit of to and fro around exactly how long the US-Iran ceasefire has been extended for. There was some sources reporting via Fox and via Axios that the ceasefire extension was not indefinite, and it was actually for between 3 and 5 days. But President Trump and the White House Secretary Caroline Leavitt coming out later on and saying that those reports were not true, that actually there is no deadline in terms of when the ceasefire ends. So it is an indefinite extension, as we had been saying yesterday. The can just basically been kicked down the road for as long as possible. And then in terms of discussions, again, nothing particularly concrete on that front as of yet, but there were some reports by the New York Post with President Trump saying that negotiations with Iran and are, quote, possible as soon as Friday. We have heard that on numerous occasions at this point, and suffice to say that the market is not particularly interested in reacting to any of it. I think we're just in this sort of equilibrium where markets have kind of priced in the idea that we're not going to see, or we're unlikely to see, a major re-escalation in terms of the conflict, in terms of kinetic action in the Middle East. Equally, we're unlikely to see the Strait of Hormuz getting reopened in short order. And I think markets are just kind of waiting for what now feels most inevitable as the next headline at some point, which is talks are going to take place on this date at this time in this venue.
Yeah, exactly that. A couple of things to note, and again, I'm trying to read between lines and kind of pick up on what I assume are smarter people than me, which low bar, etc., etc. But there's been a lot of talking heads and whatnot talking about the 30 odd Iranian sanctioned ships just kind of breezing past sanctioned ships connected to Iran. They're breezing past the blockade, and someone's pointed out, and I don't know how accurate this is, and I don't know what this means. I don't know if it means the US actually can't do anything, but obviously, many people still even now don't realize that Pakistan and Iran are kind of neighbors, right?
Well, not they are.
Well, yeah, they are, right? And you can sell a ship staying within Iranian waters along the coast and then go straight into Pakistani waters along the coast. And they're saying that the ships are just using that route because the US won't go into the Pakistani waters because then it's, all this is going to kick off. But anyway, yeah. So look,
that is correct. The one thing I would say with that is that's fine if you want to get crude to Pakistan or to India. If you want to go anywhere else, you're going to have to go into international waters. And as soon as you do, the US are going to interdict you back.
But they love a little ship-to-ship transfer, etc. There's ways around it. Where we know what Greek shipping magnates are like. Where
there's a will, there's a way, or where there's 2 million quid in cash.
Exactly. Where there's a suitcase full of readies, there is a way. Just one thing I wanted to flag as well, because we're seeing equities at all-time highs, right? People are saying, "Oh my God, equities are wrong. They're pricing in. Participants are pricing in that it's all crisis is over, etc." I would like to hear your take on this. I'm hoping it's kind of similar to mine, or else I'm completely barking up the wrong tree. But my take is that equities aren't pricing in the crisis is over, right? Equities are pricing in the FOMO trade. They're pricing in that at some point it will be over, and they, market participants, and especially long-only funds and whatnot, are benchmarking to the S&P and whatnot, real money. They don't want to be sat there sucking their thumb whilst, S&P is up 10%. We saw it during COVID. During the deepest, darkest moments of COVID, we hit a low, stocks started screaming and, getting frothy knickers. It wasn't because they thought the crisis was over. They just stepped in because they knew at some point everything's going to be all right. The support's going to be there, both monetary policy and fiscal policy. And we better get long now before it's too late and before we miss the big move.
Yeah.
So this is why we're seeing now more and more days of oil up, stocks up, which were at the start of the crisis. It was very much oil up, stocks down, or vice versa. Does that make sense? What's
it makes complete sense. I think there's actually a few other things that I would add to that. Firstly, you're absolutely right to say that participants are, effectively front running what they see as a positive outcome, which makes complete sense because equities are forward looking.
That might be, exactly, and that might be in 2 months' time.
Yeah.
It might be in 3 months' time.
Absolutely.
So, I'm glad we agree on that because again,
I was going to say there are a couple of other things I did just want to mention on that front because it's not just a geopolitical story anymore, I don't think, in terms of the equity market. You look at what else is going on. Over the last kind of 3 or 4 weeks, we've seen a big resurgence in kind of enthusiasm around the tech trade and around the AI trade, whether that be due to, a company announcements or whether that be due to valuations having cheapened so much that people are actually coming in and thinking, Microsoft, Meta, Amazon, Apple are starting to look attractively priced once again and buying that dip in size. Obviously, they've got an outsized index weighting, which helps to drag the benchmarks higher as well. The other thing I would flag is, and again, it's gone a little bit under the radar because we've had so much to talk about in terms of the Middle East, but earnings season. We are actually 20% of the way through earnings season. If you look at the number of S&P stocks that have reported, I was looking at the numbers this morning, 80% of those.
This space was downloaded via spacesdown.com. Visit to download your spaces today.
Beaten consensus EPS expectations, which is pretty solid. But what's more important than that is that the average magnitude of that surprise is the highest since at least the first quarter of 2024. So it's not just optimism around geopolitics that's driving the market higher. The fundamentals of this are actually relatively solid too. So, there are plenty of good reasons why the stock market is trading where it is, I think.
Yeah, exactly that. And it's sticking to kind of what we're seeing in terms of market dynamics. One thing I did want to just quickly touch upon your good self, oi, sniggers in the back. Gold. obviously we're getting a few people getting irate about the price action or lack of in gold. It's too quiet. Gold should be screaming higher due to conflict, etc. See, I would argue against this for two reasons. One, let's all remember that it's had a hell of a fucking 24 months or 12 months, whatever you want to call it. It's up rough 44% year to date, and it's just minding its own business. Now, two reasons for that. One, we know that during times of turmoil, you sell your most liquid assets, right? If you need to fund stuff, and we're seeing that from central banks, we're seeing that from real money accounts, etc. So they're using that to fund or just keep make sure they got margin on hand, so to speak, because it's a very liquid, deep market, and most people that have been holding it have got significant profit in it. But also, so that's obviously going against what some would assume was the natural bid coming into the market due to conflict. But also, I think you got to take a step back and say, we talk about gold as a safe haven, right? We don't talk. That doesn't mean necessarily that it should ramp when things are stressed and when things are going wrong. By definition, a safe haven means it should just be safe and quiet when the shit is hitting the fan. And this is exactly what we're seeing from gold at the moment. So I think, again, it's a misframing of people's perceptions of the market, because we've just been through a number of years where things have happened in a certain fashion and people become acclimatized to that. Same with, you could even expand this to kind of, low interest rates. Like interest rates of 0% aren't normal, but, there's so many, like a whole generation of traders and a whole generation of pundits have been brought up to assume that is normal. So what's your take on that? Am I completely talking out my arse, or do you see where I'm coming from?
No, I think there is some degree of logic in it, miraculously.
I'll take that.
I would just say it's actually just really hard to make a case for doing anything with gold at the moment. So I don't think gold has not acted as a safe haven since conflict in the Middle East began. And we actually spoke about this at some point during the month of March. I can't remember exactly when. Gold is a really good safe haven as risk is increasing, because participants are buying bullion basically as a hedge against what they see as a risk materializing on the horizon. Gold becomes a really terrible safe haven when that risk materializes, because as that risk materializes,
you need to
participants want cash, and to get cash, you have to sell down your gold holdings, which obviously drives the price lower. But if you look at where gold is trading now, let's say what it is realistically is a momentum-driven risk asset. I used the phrase the other day on the desk, retail have ruined gold. And what I meant by that was basically we've had so many of these kind of parabolic rallies, big sell-off, parabolic rally again. You can't trade it based on the traditional dynamics that we would look at. And I think when you look at gold at the moment, you go, okay, it's a risk asset. Risk sentiment is underpinned because we're slowly but surely moving towards a potential end to conflict in the Middle East. Well, I'm just going to buy stocks. Why would I buy gold if that's happening? Stocks are a much higher beta and got much better exposure to that. On the flip side, am I looking at the situation and going, are there big risks on the horizon that I want to hedge? Well, obviously the big one is a potential re-escalation in terms of what's going on in the Middle East. But actually, I don't think anyone is working on a base case that that's going to happen. Do you want to hedge a potential slowdown in growth as a result of the economic fallout from the Strait of Hormuz? Well, potentially. But why would you not just go and buy the long end of the curve that has sold off massively in recent weeks? Again, gold just doesn't really have a place in that. So, it's easy to say, oh, yeah, it's too quiet. The market's, coiling to move somewhere, blah, blah, blah. Maybe it is, but I think the reason the market's going nowhere is because there's actually no reason for it to go anywhere, quite frankly.
Exactly. And for people who are sitting there saying, oh, it's underperforming, again, it's up fucking nearly 50, it's up the best part of 50% on the year. I mean, kind of, if in doubt, zoom out kind of thing. But cool. Look, I'm glad we covered those key bits. Is there anything else from yesterday you wanted to bring up, or should we talk about this morning's UK data?
Well, we may as well talk about that, actually, because, I'm staring out the window because I'm thinking some pigs are going to start flying past in a second.
Right. Can I flag? Because I was hoping that I just completely kind of fucked up and I'm missing a massive, what is going to happen? Something is happened and I'm not aware of. But where did this number come from? I do not understand how this number came in where it did in terms of UK borrowing numbers, for those that aren't understanding where we are.
The number itself is unremarkable, to be completely honest with you. A deficit of 12.6 billion in March. The prior was 14 billion. It's basically where we expected it to be. The thing that surprised me was that the ONS are actually correct about something. Sorry, not the ONS, the OBR. The OBR are actually correct about something, because borrowing in the financial year to March 2026, which is of course the entire financial year, was 132 billion pounds. The OBR forecast borrowing to be 132.7 billion pounds. So they're only 700 million out, which for the OBR is, pretty much hitting the nail bang on the top of the head.
But I'm shocked that maybe, is it because, sorry, the reason I was shocked is I was just expecting them to be, to be borrowing more than expected again. But obviously it's actually down 33% year on year. Now, that's why I was shocked. And to be honest, I didn't look at what the forecasts were. I just expected a horrific number because that's what I've become accustomed to. My fault there. But do you think the number is actually down year on year on the March data because it's just been front run by Reeves already and because she borrowed earlier? Or what is this? Because it's not like they're kind of cutting back.
Yeah, I think there is a degree of that. And I think also when you're comparing year on year, you need to bear in mind that the borrowing figures for the financial year 2024 were just utterly horrific, and they were for financial year 2025. So we are not exactly comparing against a promising baseline, for want of a better word. The other thing I would say on this is that, this is all very backward looking. And if you're looking in terms of, where the economy now stands, the OBR, of course, said that Chancellor Reeves had £22 billion worth of headroom against her fiscal rules in the March fiscal outlook. The general kind of rule of thumb, it is a bit of a rough calculation, is that 100 basis points plus or minus in gilt yields across the curve is about 15 billion plus or minus in terms of headroom. So gilt yields are roughly 50 basis points above where they were when the OBR came up with these forecasts. So that's 7 or 8 billion of headroom gone. You've then got to account for the slower growth profile that's going to take place as a result of what's going on in the Middle East. So that will take another few yards out of the headroom. So realistically, I think the bigger take from the data we got this morning is not necessarily anything about where we were in March. It's more a case of the fiscal outlook is yet again, we're halfway through the year and it's starting to look somewhat ropey. Plus, the sort of sword of Damocles that's hanging over all of this is who the hell is the Chancellor going to be come the end of the summer, even when Keir Starmer gets replaced, and what the hell is their fiscal approach going to look like?
Well, yeah, and that's, there are going to be many, many, many shows about that. I'm going to speak to our dear friend Helen Thomas, and maybe we'll get her on at some point and do another extra show just on what is going on there, me, you and her.
Good idea.
I think that would be a very good idea. One of my many good ideas.
He says selling many.
Yeah, yours. They're selling one at the moment. It's like when PMIs went negative. What was I going to say next? Right. Anything else going on today?
Well, you've teed up a perfect segue there, because speaking of PMIs, fuck me, that was ropey.
God. I knew exactly what I was doing, honest.
Oh dear. We do have a whole host of PMI figures out today. I'm not going to go through them all. The two things I would say, actually, there's a few things I'm going to say. We get data. I've just thought of more as I'm going through this. We get data from the Eurozone at 9. We get data from the UK at 9:30, and then we get data from the US at 3:15 this afternoon. All of that being UK time, of course. The services metric in the Eurozone, that's expected to dip beneath the 50 mark for the first time since May of 2025. We're also expecting to see the composite metric here in the UK dip below 50 for the first time since April of 2025. The other thing with this is just be very careful with the manufacturing PMI numbers. There has been some degree of consternation around the manufacturing surveys on business television this morning, talking about how the French and German manufacturing numbers are so much better than expected. Firstly, they are being skewed higher because there's a lot of front running going on. People trying to get orders in, effectively last chance saloon before the energy impact hits the data. The other thing, again, we saw this during COVID. We saw this when the Suez Canal was blocked with that container ship years ago. We saw it when war broke out in Ukraine. What happens with the PMIs when supplier delivery times get longer, The PMI calculation interprets that as a sign of positive demand. Basically, delivery times are longer because there is so much demand that suppliers are struggling to keep up with it. They do not account for that being effectively a supply shock, which is what we see at this moment.
Yeah.
And that, again, skews the manufacturing data higher. So take that with a bit of a pinch of salt. Besides the PMIs, we do get the weekly jobless claims stats out in the United States. The initial claims print, that's expected at 210,000, broadly unchanged from a prior 207. Recall, of course, that does coincide with the survey week for the April non-farm payrolls report. And on the earnings docket, a couple of names worth watching today before the market open, the likes of Lockheed Martin. And then after the close, we hear from Intel and from Newmont, who are the first of the gold miners to report. And of course, geopolitical developments in focus throughout the day as well.
Exactly that. Yeah, and regarding the PMI, it is boring, but we do keep saying it. It does really pay to understand the methodology of a lot of the data sets that people are trading off of. And again, with AI and whatnot, Claude and GPT or whatever you want to call it, fucking thing, it's very easy to kind of just plug it in and say, how is this number created and what makes it up. It is boring, but it will really stand you in good stead to understand exactly the data that you're about to fight someone over on Twitter about.
Yeah, I mean, I would almost argue that in this day and age, if you are a market participant looking at data like this, there's actually no excuse to not know, not necessarily all of the weeds, but some degree of the intricacies and the inputs behind it. There's enough sources of information out there to get that information if you want it. And frankly, if you don't, then you're just being a bit lazy.
Yeah, again, it was, I think, me and you are exactly the same. When markets get stressed and things start getting a bit excitable, me and you both do enjoy when so-called professionals or so-called experts, the mask slips and they make some absolute howlers. And we saw, and this was kind of what we saw over COVID was the last time. And then we saw a bit over, when Russia-Ukraine first kicked off with the energy. And then we saw exactly the same when this conflict kicked off. Again, there's no excuse to kind of know your basics. Again, it's not glamorous. It's not punting on Lambos and whatnot, but it will stand you in good stead. Cool. Well, look, I think this has been, I think it's been successful. No one's been barking at me on Twitter saying, this is
no one said they can't hear us. No one said we're chatting shit. So I'm going to chalk that up as a win.
I mean, I think they say the latter quite a bit anyway. But yeah, I'm with our good friend Managed to Damage that he's happy that we can actually throw the Podbeam app in the bin. I wish I could, but I've now got to log on and then install this onto and publish this to all the podcast players. So again, it is going out to all the podcast players like it does usually. But I think this has been a success. So everyone, thank you very much for making the move with us. And anyone that hasn't been tuning in on the live recordings on Podbeam, welcome back. Yeah, it's good to see you, or listen to you, or listen to us. I don't know what I'm talking about anymore. I'm going to leave you. Go back to my fifth coffee this morning. Michael, pleasure as always, listeners. Hopefully we've added a bit of value and put a smile on your face. Yada, yada, yada. And we'll see you all tomorrow. Goodbye.
See you later.
Bye.
This space was downloaded via spacesdown.com. Visit to download your spaces today.